By the time silver futures light back up Sunday night, one political headline could already have rewritten the entire week ahead. Right now, the trading floor is dark. Retail investors are relaxing, analysts are off television, and most people assume nothing important happens while markets sleep. But between this moment and the COMEX electronic reopened Sunday evening, a decision made in either Tehran, Washington, or the Strait of Hormuz could slam silver sharply higher or drag it violently lower before most traders even pour coffee Monday morning. And that matters because once prices begin moving, hesitation becomes expensive. You will not have the luxury of calmly studying charts after the opening bell. You need the framework beforehand. You need to know which signals matter, which ones are noise, and why this metal is acting like a pressure chamber instead of a normal commodity market. Silver ended Friday, May 22nd, around 75.35 per ounce after losing roughly 1.7% during the final session. July futures briefly traded above 77 earlier in the week, then faded toward the close as geopolitical uncertainty returned. On the surface, it looked uneventful. Headlines described narrow movement and unusually calm trading conditions, but appearances are deceptive. Tight ranges do not always represent stability. Sometimes they represent tension packed into a smaller and smaller space before release. Think about the last several sessions carefully. Daily moves were relatively contained, yet every headline connected to oil, inflation, or diplomatic negotiations caused immediate reactions across metals, bonds, and currencies. Why would a supposedly quiet market respond so aggressively to every whisper? Because traders understand silver is balanced between three unresolved catalysts, and any one of them can shift prices dramatically in a single overnight session. The first catalyst is still the most important: negotiations surrounding Iran and energy transport through the Gulf region. Statements from American officials last week hinted at progress, while Iranian sources described additional diplomatic discussions involving regional intermediaries. Midweek comments suggesting negotiations were nearing completion pushed crude oil sharply downward in only a few hours. Several tankers moved successfully through the Strait of Hormuz, and markets immediately interpreted that as evidence tensions might cool. Silver jumped alongside gold as rate hike fears briefly eased. Then the mood changed again. By Friday, uncertainty returned. After officials clarified no final agreement had actually been reached, oil climbed back upward. Precious metals surrendered. Earlier gains. Traders who bought optimism suddenly faced renewed doubt. That rapid reversal is precisely why Monday's opening matters so much. The market is waiting for confirmation in either direction, and whichever direction arrives first could produce a major repricing before most investors can react. So let us walk through the possible outcomes one by one. If negotiators announce a credible breakthrough over the weekend, silver could open substantially higher Sunday evening. Oil would likely fall quickly toward the low $90 range, or even lower. That matters because elevated energy costs are one of the primary reasons inflation expectations surged earlier this spring. Lower oil prices reduce pressure on future CPI readings, which changes expectations surrounding Federal Reserve policy. The moment traders believe inflation risks are easing, silver's monetary appeal improves dramatically. And here's the crucial point many casual observers still miss. Silver does not move solely because of industrial demand. It operates through two separate engines at the same time. The first engine is monetary demand. Investors buy silver alongside gold when they fear weakening currencies, declining purchasing power, or falling real yields. The second engine is industrial consumption. Solar infrastructure, electric vehicles, artificial intelligence data centers, advanced electronics, and telecommunication systems all require significant silver usage because of its unmatched conductivity and reliability. Normally, both engines support each other, but the energy shock disrupted the monetary side of the equation. When oil surged above $100 after regional conflict intensified earlier this year, inflation accelerated again. Higher inflation forced markets to reconsider expectations for Federal Reserve easing. Rate cut hopes weakened. Real yields stayed elevated. Suddenly, holding Treasury bonds looked more attractive relative to precious metals. The monetary engine stalled while the industrial engine kept running alone. That is why silver repeatedly struggled near major resistance despite ongoing supply deficits and powerful long-term demand trends. Now imagine what happens if the geopolitical pressure eases. Oil falls, inflation expectations soften, bond yields retreat, the Federal Reserve appears less hawkish. Suddenly, both silver engines begin firing together again. That transition would not produce a tiny move. It could trigger an entirely different pricing environment within weeks. Could silver immediately explode higher? perhaps not overnight. But markets often move fastest when positioning is heavily compressed beforehand. Many institutions already expect stronger precious metals prices later this year if geopolitical stress declines. Several banks continue projecting significantly higher gold prices despite current volatility. And if gold advances while the gold-to-silver ratio compresses toward historical bull market levels, silver's upside math becomes extremely aggressive. Consider the arithmetic carefully. If gold eventually trades near $5,400 and the gold-silver ratio tightens toward 45-1, implied silver prices move above $120. If the ratio compresses further toward historic mania levels near 35-1, the projections become dramatically larger. This is not fantasy storytelling. It is straightforward ratio mathematics combined with institutional goal forecasts already published publicly. But there is another side to this weekend setup, and ignoring it would be irresponsible. What if negotiations fail completely? What if leaders publicly reject proposed terms? Tanker disruptions intensify again, or military tensions escalate unexpectedly. Then oil likely surges back above $110 before the next full trading session even begins. Rate hike probabilities rise further. Treasury yields strengthen. Silver could retest major support levels near 70 much faster than many traders expect. The same leverage that magnifies upside momentum can magnify downside fear just as quickly. That is why understanding the setup matters more than blindly predicting direction. And there remains a third possibility, perhaps the most realistic of all: no decisive resolution. Negotiations continue. Officials release vague statements. Tanker traffic remains uneven. Markets receive neither confirmation nor collapse. In that scenario, silver probably opens near recent levels while traders shift focus toward incoming economic data later this week. Thursday's GDP release and jobless claims numbers suddenly become extremely important under that outcome. Why? Because the market is trapped inside a stagflation debate. Weak growth combined with persistent inflation creates a nightmare scenario for central banks. If economic activity slows while prices remain elevated, policymakers face conflicting pressures with no painless solution available. And this brings us back to silver's strange behavior. Many investors watch the chart without understanding the machinery beneath it. They see price swings but miss the deeper structure controlling those swings. The industrial foundation underneath silver remains remarkably strong despite geopolitical chaos. The Silver Institute's latest survey confirmed another annual supply deficit, extending a multi-year streak of shortages. Mine production remains constrained, and most global output arrives as a byproduct of mining for other metals, rather than dedicated silver extraction. That means producers cannot rapidly increase supply simply because prices rise. Meanwhile, demand tied to renewable energy, electrification, and digital infrastructure continues expanding worldwide. Even with manufacturing disruptions and slower growth, the long-term industrial appetite for silver has not disappeared. China's export restrictions on refined silver added additional pressure to already strained global supply channels. And beneath everything sits a futures market carrying substantial paper leverage against available physical inventory. That leverage matters. When too many paper claims exist relative to deliverable supply, markets become increasingly unstable during periods of sudden demand. Under normal conditions, the imbalance remains manageable. During moments of panic or aggressive buying, however, traders begin demanding physical settlement rather than rolling contracts forward. That is, when volatility accelerates. Ask yourself this: what happens if both silver demand engines restart while physical availability remains constrained and paper exposure stays elevated? That is a scenario long-term bulls believe could create explosive price discovery later in the cycle. Now let us discuss another overlooked development from Friday's data releases. Consumer inflation expectations from the University of Michigan survey softened slightly compared with previous readings. The changes were modest numerically, but direction matters more than magnitude in this environment. Why? Because inflation psychology influences spending habits, wage demands, political pressure, and Federal Reserve behavior. When households expect rapidly rising prices indefinitely, inflation becomes harder to control. When expectations stabilize or retreat, policymakers gain breathing room. Traders monitor these reports closely because they provide early clues about future monetary conditions before official CPI numbers arrive. If future readings continue easing while geopolitical stress cools simultaneously, the narrative surrounding rate hikes changes very quickly. And that would directly benefit silver. The next Federal Reserve meeting in mid-June may become one of the most consequential events of the summer for metals traders. Markets currently expect officials to maintain rates, but future projections inside the updated dot plot could reshape expectations dramatically. Even subtle shifts among committee members toward eventual easing rather than further tightening would likely be interpreted positively for precious metals. On the other hand, if policymakers signal deeper concern about inflation persistence, silver could remain trapped beneath major resistance for longer than bulls hope. This is why the current setup feels so compressed. Multiple forces are colliding simultaneously. Energy markets, inflation expectations, interest rate projections, geopolitical negotiations, physical supply constraints, institutional positioning. Every variable feeds directly into the next one. And because all these forces remain unresolved together, the eventual release could become exceptionally violent. Now let us widen the lens for a moment. Gold continues trading near historically elevated territory, despite geopolitical chaos and aggressive bond yields. That alone tells you institutional concern about currency stability and sovereign debt has not disappeared. Several major banks still project substantially higher gold prices into late 2026. If those forecasts remain intact, while silver supply deficits continue, eventually attention shifts toward the ratio imbalance between gold and silver. Historically, silver tends to lag initially and then accelerate rapidly during precious metals bull phases. Once momentum begins, it often outpaces gold dramatically. That pattern is one reason experienced commodity traders are watching this environment so closely despite current volatility. And remember, silver already demonstrated its ability to move aggressively when both engines aligned earlier in the cycle. Investors who believe geopolitical stress merely delayed the larger trend rather than destroyed it are positioning for the trends. Possibility that current weakness represents compression rather than collapse. Could they be wrong? Absolutely. Markets punish certainty. Risk always exists. No commodity rises forever, and no thesis survives unchanged indefinitely. That is why disciplined positioning matters more than emotional conviction. But dismissing the structural forces underneath silver entirely would also ignore enormous evidence accumulating over several years. This is not merely a story about a shiny metal. It is a story about energy, technology, inflation, debt, geopolitics, and industrial transformation all colliding inside one market. That combination creates extraordinary opportunity and extraordinary volatility at the same time. So heading into Sunday evening, watch the headlines carefully. Monitor developments surrounding Gulf shipping routes. Watch whether diplomatic language becomes more optimistic or more hostile. Track oil futures immediately when electronic markets reopen. Pay attention to bond yields and inflation expectations. Then watch Thursday's economic data, because growth weakness paired with sticky inflation would intensify the stagflation debate even further. Most importantly, understand beforehand what scenario you are actually trading. Too many investors enter volatile markets emotionally unprepared. They react to headlines without frameworks. They chase candles after the move already happened. This environment punishes that behavior quickly. Preparation matters far more than prediction right now. And if geopolitical tensions eventually ease while industrial demand stays firm, silver's long-term structure could look radically different by year's end than it does today. That possibility explains why institutional attention keeps growing despite short-term uncertainty. Before we close, I want to leave you with one final thought. Every major commodity cycle feels confusing while it unfolds. At turning points, the signals always appear mixed. Fear and optimism exist together. Analysts disagree violently. Headlines reverse daily, yet underneath the noise, structural trends continue developing, whether television commentators notice them or not. Silver may be approaching one of those moments now. If this breakdown helped you understand the forces driving the market, support the channel by hitting like and subscribing to Winds of Thought so you never miss the next major development. Share this video with anyone holding silver or watching precious metals, because Sunday night's open can set the tone for everything that follows this summer. The next few days may tell us whether silver remains trapped in uncertainty or begins a completely different phase altogether.